The family home is completely exempt from the age pension assets test. That's the rule most Australian pensioners know. And they're right. But what most people don't realise is that the same home can become a Centrelink liability, a deprived asset, or an unexpected CGT problem almost overnight, depending on one decision made with the very best of intentions, and often no advice at all. And the decisions that trigger it usually feel like common sense at the time. That's what makes them so costly. I'm Claire. I work in tax and superannuation, have done for around 15 years now. And my whole reason for being here is to explain the rules that genuinely affect Australian retirees in plain language, the way you'd want a knowledgeable friend to explain them. Not alarming, not complicated, just clear. And today I want to talk about the family home, because it's where I see some of the most avoidable, most expensive mistakes happen. Not because people are careless, but because the rules around the home in retirement are genuinely more layered than anyone tells you before you're already in them. None of what I'm going to cover today is about people doing the wrong thing. Every single one of these mistakes comes from a reasonable instinct. To protect the house, to help the kids, to simplify things. The gap isn't in the intention, it's in the knowledge. And that's fixable. So today I'm walking through 5 mistakes I see trip up Australian pensioners when it comes to the family home. Mistakes that can affect your pension entitlement, your CGT position when you sell, and in some cases your actual security of tenure in the place you're living. 2 of them sit inside the Centrelink rules. One is a reporting issue that catches people at the worst possible moment. One is a timing problem with thousands, sometimes tens of thousands, of dollars on the line. And the last one lives inside the tax law, arrives years after the decision, and almost nobody sees it coming. Let's start with the one I get asked about more than any other. The most common one, and honestly the one that hurts families the most, is the decision to sign the house over to the kids. It makes complete intuitive sense. The thinking goes, if the home is in my name, aged care might count it, or Centrelink might eventually come after it. If it's in my children's names, it's protected. A lot of people have heard some version of this from a friend, a neighbour, someone at the bowling club. And the logic sounds solid until you understand how Centrelink actually reads that transaction. Under the Social Security Act, giving away an asset, or selling it for less than market value, is called a gift. Centrelink allows you to gift up to $10,000 in a financial year, and no more than $30,000 over a rolling 5-year period, without it affecting your age pension. Anything over those limits is treated as a deprived asset, which means Centrelink counts it as though you still own it, for 5 years from the date of the gift. Now apply that to the family home. If you transfer it to your children for nothing, or for well below what it's worth, the entire value above that $10,000 annual allowance sits on your Centrelink file as a deprived asset. Assessed as a financial investment, subject to deeming, for 5 years. And here's the part that really stings. The home was completely exempt from the assets test while you owned it and lived in it. The moment you give it away, that exemption disappears. You no longer have the asset, but Centrelink still counts it against you. The protection you thought you'd created doesn't exist. The 5-year clock also doesn't pause when you reach pension age. If you transfer the home at 64 and apply for the age pension at 67, Centrelink looks back 5 years and finds it. You're still carrying that deprived asset into your 2nd, 3rd year of pension eligibility. And when aged care comes into the picture, the same 5-year look-back applies to the means assessment. The home can still be counted, even though it's been out of your name for years. What I see in practice is a parent, usually in their late 60s, acting entirely in good faith, who transfers the family home after hearing that it's the thing to do. The land titles data gets matched to Centrelink records. The transfer is flagged. The deprivation rules apply. And the parent is sitting with a deprived asset of $500,000 or $600,000 on their Centrelink file, a changed pension entitlement, and no home. That's the outcome of a decision that was supposed to protect them. Genuine planning around assets before a pension claim does exist. There are legitimate strategies for people with the right circumstances and enough time, but those strategies need professional advice built around your specific numbers. If someone has raised this idea with you, the conversation to have, before anything changes hands, is with a licensed financial advisor or a free financial information service officer at Services Australia on 132300. Ask them, I'm thinking about transferring my home to my children. Can you help me understand exactly how the gifting and deprivation rules would apply to my situation? That's the right question, in the right place, at the right time. The second mistake is related, and a lot of people land on it as the safer alternative. Rather than transferring the house outright, they set up what's called a granny flat arrangement, which sounds simple, but the term means something very specific in Centrelink's world, and the details matter enormously. A granny flat interest is not a building. It's not a self-contained unit out the back. In social security law, it's a lifetime right to live somewhere, in exchange for transferring assets or money to the person who owns that property. You can establish one in a spare bedroom. The physical space is almost beside the point. What matters is the legal right, and whether that right is actually documented. Done correctly, with proper structure, a granny flat arrangement can work well. The entry contribution may be exempt from the assets test, and depending on what you paid, you may be classified as a homeowner for pension purposes. From 1st July 2025, you generally need to have transferred more than $258,000 to reach that homeowner threshold. Below that, the amount paid is assessed as an asset, and if the arrangement is more complex, if you've transferred more than what Centrelink's reasonableness test values the lifetime right at, based on your age, the excess becomes a deprived asset. The exact figure varies by age, which is exactly why this needs a professional to run the numbers before anything is set up. But the issue I see most often isn't the Centrelink calculation, it's the absence of a formal legal agreement. No document specifying the lifetime right, no clarity on what happens if the property is sold, if the relationship deteriorates, if the child's circumstances change dramatically. Without that, a pensioner who has transferred their home, sometimes their entire asset base, is living somewhere on goodwill alone. The pattern is a widowed parent in their mid to late 70s who moves into a child's home after handing over the family property. There's no written agreement. The family is close and it all feels unnecessary. Then something shifts. A marriage breakdown, financial pressure, a change in living arrangements, and the parent has no enforceable right to stay. A solicitor-reviewed family agreement, written before anything is transferred, that spells out the lifetime right and what happens in foreseeable circumstances, is the difference between that situation and a safe one. Centrelink doesn't require it. A court might. Those first two mistakes happen before any move is made, in the planning stage, when a family is trying to do right by everyone. The next three are different. They happen to people who've thought things through, made a reasonable decision, and then got caught by a rule nobody mentioned at exactly the wrong moment. If you're on the age pension, you are legally required to notify Services Australia within 14 days of any change to your income or assets. Any change. Selling your home, moving out, establishing a granny flat arrangement, starting to rent a room, all of it. The 14-day clock starts at the event itself, not when the paperwork settles, not when you feel ready. Most people don't miss this deliberately. Selling a home is genuinely exhausting. Settlement lands, the removalists arrive, there are boxes and keys and 100 decisions at once. Calling Centrelink feels like something to do once things calm down. And because the pension keeps arriving in the account, everything feels like it's ticking along. It isn't. Centrelink receives data from land title offices across Australia. The ATO shares property transaction information. Banks report significant deposits. This is not a system built on trust and self-reporting alone. It's a system with data matching. And when the match flags a discrepancy, Centrelink opens a review and works backwards. If they determine you were overpaid because your asset position changed and you didn't report it, they raise a debt. That debt is recoverable from future pension payments and tax refunds, and it accrues from the date the change occurred, not the date anyone noticed. The exact words matter here. Within 14 days of settlement, contact Services Australia through MyGov or on 132300 and say, I have sold my principal home and I intend to use the proceeds to purchase a new principal home. I'd like to apply the principal home sale proceeds exemption. That framing starts the right process. It's the difference between those proceeds being exempt from the assets test for up to 24 months and then being an assessable asset from day one. The 24-month exemption is where the fourth mistake lives, and it's the most financially significant one for most people. While you own your family home and live in it, it doesn't exist in the assets test at all. From March 20th, 2026, a single homeowner can hold up to $321,500 $500 in other assessable assets and still receive the full age pension. A couple sitting at $481,500. The home, worth whatever it's worth, is invisible to that calculation. The moment you sell, the proceeds are a financial asset, unless you correctly apply for and are granted the exemption, which protects the portion intended for a new principal home for up to 24 months, with some circumstances allowing up to 36. What the exemption doesn't protect is the income test. Those funds, while they sit in your account, are deemed. From March 20th, 2026, deeming runs at 1.25% on the lower portion and 3.25% above the threshold. That deemed income can reduce your pension during the very period you assumed the sale proceeds were invisible. Many people find this out at their next Centrelink review, which is not an ideal time to discover it. And then there's the 90-day window. If you're 55 or older and have owned the home for at least 10 years, you may be eligible to contribute up to $300,000 each, $600,000 as a couple, from the sale proceeds directly into super as a downsizer contribution. It doesn't count against your concessional or non-concessional caps. It's one of the most genuinely powerful provisions available to Australians at this stage of life, and the window to use it is 90 days from receiving the sale proceeds. Not from settlement, from the money arriving. The ATO can grant extensions in limited circumstances, but those aren't guaranteed, and late requests are routinely declined. If you're selling and you might be eligible, this question, do I qualify for the downsizer, and is the 90-day timeline workable given our settlement, belongs in a conversation with a licensed financial advisor before you sign the contract on your current home, not after. The fifth mistake is the one that genuinely gets to me. Not because it's the most complex, but because of who it catches and when it catches them. The CGT main residence exemption is one of the most valuable provisions in the entire Australian tax system. If your home has been your principal residence for your entire ownership period and was never used to produce income, any capital gain when you sell is completely exempt. For a home bought for $200,000 and sold for $900,000, that's a $700 gain, and none of it is taxable. That is an extraordinary protection for ordinary Australian families. The condition that most people don't know is this: the full exemption only applies if the home was never used to produce assessable income. Never. If you rented out a room, informally for a modest amount, to a student, to a friend, through any arrangement, during any period of your ownership, the ATO applies a partial exemption. During any period of your ownership, the ATO applies a partial exemption. The calculation is based on the floor area used to produce income and the proportion of your total ownership period it was rented. A spare bedroom at 15% of the floor area, rented for 10 of 30 years of ownership, produces a meaningful taxable gain even after the 50% CGT discount for assets held over 12 months. Added to your other income in the year you sell, it can shift your tax bracket, affect your Medicare levy, and interact with any means-tested entitlements you hold. The people I see in this situation are in their 70s and 80s. They took in a boarder during the years when money was tight, when the pension didn't quite stretch, when the spare room was just sitting there. The income was small. The arrangement felt informal. Nobody told them at the time that what they were doing was quietly reducing their main residence exemption, year by year, in a way that would only become visible decades later when they finally sold. They did something sensible and practical to make retirement work, and they get a tax bill for it at the exact moment they're trying to simplify their lives. The law isn't wrong, but it is a rule that almost never gets explained until it's too late. And the ATO, which data matches rental income, boarding arrangements, and short-stay platforms, will find it in the records. If you have ever rented out any part of your home, even briefly, even years ago, before you sign a sales contract, take a note of the approximate floor area and the dates to a registered tax agent. Ask them, given the periods my home was used to produce income, do I have a full or partial main residence exemption? And what is my estimated CGT exposure at market value? That one conversation, before the contract, is worth more than any amount of scrambling after settlement. 5 different mistakes, and underneath all of them, the same thing. A decision made about the family home, to transfer it, to restructure it, to sell it, to rent part of it, without the specific knowledge of how that decision reads to Centrelink or to the ATO. The home feels like a private matter. In retirement, it is the most closely examined asset most Australians will ever own, sitting at the intersection of two different regulatory systems that don't always point in the same direction. That's not a reason to be anxious about it. It's a reason to go in with clear eyes. You don't need to carry all 5 of these at once. If one of them landed close to home, if you recognize something in your own situation, start there. Just that one. 3 things worth doing this week. If someone in your family has raised the idea of transferring the house, before anything changes hands, call the free financial information service on 132300 and ask them to walk you through the gifting and deprivation rules for your situation. That call costs nothing, and it could save you years of unintended consequences. If you've sold your home in the last 14 days and haven't yet contacted Services Australia, do that today. Log into MyGov or call 132300 and use those words. I'd like to apply the principal home sale proceeds exemption, and if you've ever rented out any part of your home and you're thinking about selling in the next year or 2, see a registered tax agent before you sign the contract, not after. Everything I've covered today is general information. It's here to help you understand how these rules actually work, not as advice for your specific situation. Your own circumstances have details that matter, and those details belong in a conversation with a licensed financial advisor, a registered tax agent, or a free financial information service officer at Services Australia, depending on what you're dealing with. Thank you for being here. Take the one thing that applies to you, make one call, and go from there. That's genuinely all it takes to start.